In investing as well as in life, you cannot do the same things as others and expect to outperform. Hi everyone, so in this video, I'll be sharing my takeaways from the book The Most Important Thing, The Uncommon Sense for the Thoughtful Investor by Howard Marks. Howard Marks is actually the founder and the chairman of Oaktree Capital Management, and in this book, he actually shares some of the most important things that we should take note of in order for us to be a successful investor. So the title of the book is kind of a joke because Howard Marks used to always say that the most important thing is controlling risk, or the most important thing is having second-level thinking. The book is like a compilation of what he considers the most important things in the world of investing as well as understanding the markets. So let's just jump straight into the 4 key takeaways. So the first takeaway that I have is that most things comes in cycles. It might be very common for some people to think that when the times are good, the market will go up forever, and when the times are bad, the market will just pull back and go down forever. But remember that at the end of the day, most things will prove to be cyclical and extreme market behavior will always reverse. Quoting directly from Howard Marks, he says that nothing goes in one direction forever. Trees don't grow to the sky. Few things goes to zero. Howard Marks, he actually believes in 2 concepts. Rule number 1 is that most things will prove to be cyclical. And rule number 2, some of the greatest opportunities for gains and loss comes when people forget rule number 1. So the most important thing for us as investors is to be attentive to cycles. Howard Marks compares the stock market to a pendulum that swings from one side to the other, swinging between euphoria and depression, between greed and fear, as well as being overpriced and underpriced. Those who think that the pendulum will swing in one direction forever or stay in one side forever will eventually lose huge sums, because the reality is the stock market actually proved to be cyclical in the end of the day, and those who are able to understand the pendulum's behavior will be the ones who will benefit tremendously. The second takeaway is having second-level thinking. So what is having second-level thinking? Before that, we can look at what first-level thinking is. So first-level thinking is very simplistic and very superficial. It's about simple formulas and easy answers. For example, almost everyone can make the same judgment that coronavirus is bad for the markets and the outlook for companies are unfavorable. So in general, all the stocks will go down. But second-order thinking is more deliberate and higher order. It's about thinking in terms of systems and interactions and understanding that the world does not work in silos, and there are many things that actually impact a company's performance. So here's an example of second-order thinking. When COVID-19 happened, it sparked a sell-off in all equities, including tech stocks, because spending and consumption has decreased. But businesses must continue to spend and build their online communications infrastructure because work from home has become the norm. Nobody considered this second-order effect, and these tech stocks has skyrocketed. So quoting directly from Howard Marks, he says that the upshot is simple. To achieve superior investment returns, you have to hold non-consensus views regarding value, and they have to be right. That is not easy. The good news is that the prevalence of first-level thinkers increase the returns available to second-level thinkers. To consistently achieve superior investment returns, you must be one of them. So this also relates to the concept of contrarianism, which is popularized by Warren Buffett. Contrarianism is not just about doing the opposite of the crowd. It's also about knowing why the crowd is wrong. So to practice second-level thinking, you have to think in terms of probability. Here are some of the guiding questions. Out of the range of future outcomes, which outcome do you think will occur? What's the probability that you are right? What does the consensus think? What will happen to the asset's price if the consensus turns out to be right? And what if I'm right? Linking to the next takeaway, it is to understand risk. I'm sure you've come across the phrase higher risk, higher returns. But this is a common misconception. Riskier assets do not necessarily give you higher returns. For example, a company that is considered bad or risky might still be able to generate good returns for you. Any investment bought at the right price will allow you to generate returns and make money. In value investing, high returns and low risk can be achieved simultaneously. The key here is to understand the difference between risk and volatility. Some people might think that the stock is risky because the price fluctuates too much. But this is not true because risk does not equal to volatility. Risk is the uncertainty of outcome and the probability of loss, whereas volatility is about price fluctuations. Stock prices fluctuate all the time due to investor sentiments as well as the market conditions. And we shouldn't associate this with a stock being risky because risk does not equal to volatility as mentioned. We have to see volatility as opportunities for us to buy and sell. Volatility is actually the price of admission. So remember that high returns and high risk does not necessarily come hand in hand. When purchasing a stock, we have to look at the fundamentals of the company and buy something that is of a discount to its intrinsic value. And if you flip it around, the absence of loss does not equate to a safe portfolio. Risk may still be present even though there is no loss occurred when the market is stable or when it's rising. As Warren Buffett mentioned, only when the tides go out, then we will realize who are the ones swimming naked. The final takeaway is to appreciate the role of luck. So how do you judge whether you have made the right investment decision? Do you look at the profits that you made in your bank account or the percentage growth of the stocks? The answer is actually none of them because the correctness of the decision cannot be judged based on the outcome. To judge if your decision is right, you have to look at your reasoning and your analysis. Or in other words, the investment thesis as to why you are investing in a stock. So quoting directly from Howard Marks, he says that a good decision is one that is optimal at the time it is made, when the future is by definition unknown. It is one that a logical, intelligent, and informed person would have made under the circumstances as they appeared at the time, before the outcome was known. Hindsight is always 20/20. When you make a good decision, it can have a bad outcome, but bad decisions can have good outcomes. For example, if you invested your money in almost any stock during the March crisis last year, you would have actually made money. We are all humans and we have cognitive biases that we have to overcome when investing as well as judging the performance of our investments. As Nassim Taleb says, you can be a lucky idiot. So here's a quick recap of the 4 key takeaways. Firstly, most things comes in cycles. No point in predicting and extrapolating trends because extreme market behavior will always reverse. Practice second-level thinking and having non-consensus view in order to beat the market. Understand that risk does not mean volatility, and controlling risk is one of the most important things that an investor should look out for. Finally, appreciate the role of luck. A lot of things that happen are actually not because of our own skill or our own competence, but it is also due to all the other factors that are possible, and we should always be aware of that. On the topic of luck and randomness, there's a book that I really enjoy called Fooled by Randomness by Nassim Taleb. In the book, he actually explains the concept of black swan events that have very low probability but very high impact, and it does extreme damage, such as COVID-19. And this book is actually quite relevant to investing as well as your life. I really highly recommend the book. So the greatest summary I have for the book is that in investing as well as in life, you cannot do the same things as others and expect to outperform. It's about your second level thinking, not so much on the outcome that proves whether your decision was right. All these ideas that he shared are simple but difficult to practice in real life. That's all I have for this video, and if you'd like to read more and find additional resources, I've linked them up in the description box below. Stay safe and I'll see you in the next one.